Hey, Sagi, good to see you here. Give me a minute. Hi, welcome. I think you're the first one here from the looks of it. Yeah, it's loading. My PDF is loading. So what do you actually do for work? So are you at work listening to the live stream now? Oh, okay, that's cool. Yeah, so today we'll be talking about Oscar. I'm not sure whether you're one of those that asked me about Oscar. I know a couple of people commented in the past. I think while we're waiting for people to stream in, let's just take a look at how the markets are doing today. I think it's fairly flat, or at least my portfolio is flat. I'm not too sure how the market is doing. Yeah, I agree. I think many people do think that Oscar is fairly undervalued for the price that it is trading at. And I think the CEO actually said so himself. And later on, I'll be showing a video where he actually breaks down for you how he thinks about the company and why he thinks this is actually undervalued for where it is right now. But I think there are a lot of things, or not a lot of things, there are a couple of things that need to happen in order for the company to be valued in a way that the CEO thinks it should be. Right, let's give me a second. I mean, yeah, definitely. It's not it's not healthy to keep looking at our portfolio, I guess, especially if you are investing for the long term. But at least for me right now, it's a occupational hazard. I mean, I have to do it every day because my work involves managing people's money. All right. So I mean, S&P fairly flat, up 0.08. The Qs are up nearly 0.2, and the Dow Jones is flat. I think the markets are fairly muted, more or less waiting for Nvidia to release their earnings tomorrow. And I think after the sort of exuberance, I wouldn't call it exuberance, but the kind of run that we have had throughout much of April to July, leading into August, I think that it's fair that the market takes a little bit of a breather. It doesn't necessarily have to go down. I know in September, it tends to be a more volatile month. In fact, I'm positioning myself for a volatile September. But I think all in all, it's really not too bad. There's no news or no big news coming out that should shake the market in any way. And yeah, I think it's fairly safe to say that right now the markets are probably in wait and see mode. They already know that Jerome Powell is going to be cutting in a couple of weeks' time. I believe that's why companies like SoFi are running. Then I think you're seeing certain sectors of the market. Well, obviously not everything is red, right? So let me take a look. Okay, Duolingo is down, Lululemon is down. Actually, tomorrow I'll be talking about Ons Holding, which is a competitor to Nike and Lululemon, and I think I think this is going to be an interesting comparison. Tomorrow, initially, I just to do just Ons by itself, but I think I'm going to be comparing it to Lululemon because I actually just sold a put on Lululemon yesterday for 19th September. Yeah. So I believe the puts Lululemon for 19th September, or it's $9 now. I got it at $8.75 yesterday. So slightly down on them for now. But yeah. I mean, I wouldn't mind buying Lulu at 190 at this point. And I think for me, another consideration when I pick companies to invest in is they need to be able to have enough volatility so that I can run the real strategy on them to generate some form of income. The reason, yeah, and like I said, the reason for that is because I use this to actually supplement my income, so I don't have to be at work all the time. And yeah. What do I think about Weibo stock? I mean, okay, wait. What do you mean by is this Weibo? Like this platform? This platform is Weibo, yes. What do I think about the stock? Honestly, I'm no real opinions on it. I know a lot of the content creators were excited about it, and then within a couple of days of getting on board, they all left because of certain disclosures about who they chose to partner. I think for me, I like Weibo's interface right now. At least with the one in Singapore, Weibo Singapore, it's quite annoying because they don't allow me to sell covered calls on naked covered calls, right? And I think that kind of in a sense they've been here for a while, and I thought they would be able to allow me to do that by then. And I think that it's quite for example, like I have enough money in the account, obviously, but let's say I want to buy, let's say I sell a covered call for HIMS in the $60 range, and I only have 100 shares, then I'll only be able to sell one covered call. Whereas previously, with IBKR, I was able to sell 2 or 3 and then basically cover the positions as the stock gets closer. The only issue I have with IBKR is that I really find the user interface very not user friendly. So that's why in the end I decided to leave and come on to Weibo. I like Momo's interface as well. I think they have a new beta version of their desktop, but I think it's I think it can get a little bit messy. Yeah, so I really am waiting for Robinhood to come over to Singapore and see the types of products offerings that they have, and hopefully move the portfolio over to Robinhood by then. Why am I not covering HIMS in the 10 stocks in 10 days? Well, that's because HIMS, SoFi, and Grab, these 3 companies are the 3 that the highest allocation in my portfolio. I think right now Grab is no longer in the top 3. Actually, Oscar has replaced it in the top 3. And it's purely because of the reason is because of options. But I think I decided not to cover it in the 10 stocks in 10 days because people in general already know my opinions about these stocks, especially like SoFi. I did a new valuation based on their Q2 2025 earnings. So I don't really have much new to say. However, I think next week what I'll be doing is that over these 10 days, I have tightened up the framework somewhat, and then using this framework as I tighten it up, I will run SoFi, HIMS, and Grab through this framework and basically show you how they score relative to some of the companies that we are doing. And then I think regarding Grab, I think somebody was asking me about Grab recently. I'm going to do a live stream morning my time, probably around 9 a.m., which is 9 p.m. Eastern Standard Time, if I'm not mistaken. 9 p.m. your time in the US. And basically the plan is to talk about Grab, their earnings. And at the same time, I'm going to show you a live demonstration of the app. So I'll be ordering food, taking a look at basically the peak hour traffic and things like that. Yeah. So actually, some of these stocks in the 10 stocks in 10 days, it's the reason one of the reason why I'm doing that is because I do want to get ready. Should there be a market correction in any way, that I want to know there are certain companies out there that I'm comfortable in adding. So there are certain companies that people have asked. I think they match certain criteria that I'm looking for. So for example, Lululemon is definite. It's not one that people have asked me. People ask me about ONS, but I was always interested in Lululemon, and so I'm going to be comparing these two companies. Nike, I mean, I like Nike, but personally not as interested in Nike compared to the other two, despite I do think it's undervalued. Yeah, I mean, I got no brand affinity with Nike, but with ONS and with Lululemon, the reason why I actually like it is because, especially Lululemon, it's one of those companies where I always felt like their products were overpriced and never wanted to buy their things. And however, when I got forced to try it, I went to try it and like, oh my goodness, that my reaction when I tried their clothes. Oh my goodness, no wonder people are paying a premium for this. Yeah, especially the shoes from ONS are a real surprise, which I will talk about tomorrow as well. How is Oscar undervalued? Well, I think you have done later on. I'll be covering it, but it's basically how insurance companies are being valued. So what the CEO does is that he uses a certain framework in terms of revenue and margin, and he says that, look, this other company in the insurance space, when they were producing this revenue and this margin, this was the multiple that was being applied to their company. And so similarly, if Oscar produces that revenue and that margin, then you should be applying a similar multiple to us. And I think that's how he's getting that number, and that's why and how people think. So it's not just people that are thinking Oscar is undervalued. The CEO himself actually says that also. All right, so with that, let's get started. Today, we're going to be talking about Oscar Health. Okay, so at certain points of this, I'll be stopping to answer some of your questions over here. But I do think that this is a company that is pretty interesting. It's one of those that I decided to invest and investigate, right? So this is actually day 6 of covering 10 companies in 10 days. And so I think it's really just nice that during that time, I was asking for companies and a lot of you actually asked me about Oscar. So I don't claim any credit for having found this company. You guys asked me about it. Then at the same time, I believe this company was gaining traction on FinTweet. And then I started seeing people talk about it. And I do have some experience in the finance, insurance space and things like that. So because of that, having this prior understanding, I decided to look into this company. And I quite like what I see so far. Although there are definitely risks involved in this company. But I think today we'll be talking about certain things that at least I couldn't find this information online, because when people cover Oscar, people tend to talk about just their revenue growth and things like that. But I want to dig a little bit deeper to talk about the sustainability of the revenue growth and the competence of management to continue maintaining that kind of revenue growth, especially with all the headwinds about the ACA regulation and things like that. So in all honesty, when I'm looking around online, I think initially when I first started to look into this company, I think there's a certain way that I like to look at companies where it made it hard for me to find some of this information that I wanted to know online. But based on certain clips, so basically how I did some of the research over in Oscar is that I look for clips on X. And then after looking at the clips on X, I go to YouTube and then I try and find the long form of that video and things like that. So basically what we'll be doing is to take you through why I think the management is competent and why I think they are positioned in a way that is fairly unique, certain metrics that you can track along the way to know that this is actually a fairly good my options position on this later on, right? So with that, I do want to start from the beginning when it comes to Oscar, because I believe this video, or the aim of this video, is to take you through my thought process and what got me to increase my stake in this company. Initially, when I started out, it's just a 2 to 3% position in the portfolio, and then recently increased it to about a 10% position in the portfolio. So Oscar Health was founded back in 2012 by these three gentlemen that you see on the screen over here. I'm sorry if I butchered their name wrong, but yeah, Mario Schlotzer, I think. Josh Kushner, who is the brother of Jared Kushner, which is Trump's son-in-law, as well as Kevin Nazemi. Now, I believe Kevin really left the company even when I first started looking into him, because they were talking mostly about Mario and Josh. But I believe he was a former Microsoft executive. So these three, they started this company because they were motivated by their own personal frustrations around dealing with the healthcare, the US healthcare system. They felt like the billing was constantly very confusing, very opaque. And I think the consumer always seems to be taking the shorter end of the stick. And I don't think it is just the healthcare in the US. I think a lot of places in the world, a lot of these developed nations, people just find the insurance companies tend to be a little bit more on the sketchy side. And so what happened over the last couple of years is that Mario was initially the CEO of Oscar. He basically stepped down and made way for a new gentleman, Mark Bertolini, to take his place as the CEO of Oscar. And so he's the gentleman that we see in the middle of the screen over here, right? And so that was, I think, sometime in early first quarter of 2023. And I think this is an important fact, understanding that Mario actually stepped down and allowed Mark to take his place as the CEO. This is an important fact to remember, and later on I'll come back to this as we go through the story of Oscar. So being a Singaporean, even before I increased my position in this company, I didn't just have to understand Oscar, because this is slightly different than if you compare a company like SoFi, right? Because like with SoFi, it's just a bank. So, banks more or less work the same way. They may be working in different demographics, slightly different regulations. But I think for Oscar, being in the insurance space, the healthcare system in the US works fairly differently from what I have in Singapore. And so because of that, it made it a little bit more difficult for me to understand Oscar's positioning and how they can actually gain new customers over the incumbents. So from what I understand, do correct me if I'm, especially since many of you are from the US, because like I said, the only evidence that I get that is really on the ground is a couple of my friends who are staying in the US, and that's about it. So if I do have anything that I mentioned that is perhaps not as accurate, please feel free to give me the nuanced argument in the stream as well. Mr. Aston asked, is Lulu not about to drop profit margins? I guess so, which is why they are falling as well. I think they basically lowered their guidance, but I'll cover that tomorrow. Okay, so from what I understand, the US healthcare insurance system is a mixed model. So you guys combine both private and public options, right? There's no automatic universal coverage for all US citizens. And so what that means is that usually people in the US obtain your insurance through employers. And this is actually quite interesting to me, because hardly anybody in Singapore gets it through the employers unless you're working for a huge company. But even then, people tend not to want to do that, because once you leave the company, the insurance doesn't cover you at all. So apart from that, people get it through individual and family purchases. So you have these things called insurance or marketplace, like the healthcare.gov and the ACA marketplace, right? Or government programs. So government programs are your Medicaid and Medicare. So to me, this is actually a slightly different model from Singapore, because in Singapore, I'm just going to quickly give you the idea of what we have in Singapore, and then use that to reference what I'm talking about in the US, so that you can see where I find the value for Oscar Health. So in Singapore, we have this base layer plan, which our government calls MediShield Life. And the main purpose of this plan, right, it doesn't pay out a lump sum or anything like that. It's supposed to cover your hospital bills, and you will be covered up to B2 and C-class wards in public hospitals in Singapore. So this is the most basic tiers of wards, where you share the ward with a bunch of people. So the premiums over here, they are deducted from, in US terms, our version of the Social Security in Singapore. Now, this MediShield Life is actually a lifelong insurance that starts from birth. There's no need for any sort of enrollment periods. There's no switching and things like that. It is automatic. It is offered by the government, and it is non-optional. So everybody has it the moment you are born in Singapore. So there are no such things in Singapore as enrollment period, and this plays a crucial part in me understanding Oscar, and I'll explain a bit later on. So, but I think similar to the US, you also have the co-payment portion as well as the deductibles portion. However, I'm not too sure whether you have this in the US and whether companies like Oscar offers this as part of their plans. But in Singapore, you can actually engage a private insurer to boost the benefits of this basic plan that the government offers. And then you can add a rider on top of that, right? Which basically caps your maximum out-of-pocket expense for both the co-payment and deductibles. Of course, that means you do have to increase your premium paid every single month. But for instance, my mum, who recently underwent a surgery, the surgery was in the ballpark of 35,000 Sing dollars, but her out-of-pocket expense turned out to be only 1,600. So that includes the surgery and the hospital stay. So this base layer, like I said, covers everyone, irregardless of pre-existing conditions. Now, but private insurers in Singapore are allowed to reject applicants due to the pre-existing conditions that they have, or they charge a higher premium to include them within the plans. And so for me, when I first entered into the US healthcare industry and started to take a look at it, it was of course slightly concerning that if people get plans on the ACA marketplace, insurers have to take them despite the pre-existing conditions. And I'm not too sure how the math will actually work out over there, and which is why I had to do a little bit of a digging to understand how it actually works. So, and I think this is actually a good thing, and it provides a very competitive to me at least, it provides a very competitive healthcare space, ideally. Whether or not that actually is the case, I think that remains to be seen. So in the ACA, basically it prevents things like gender discrimination, and because I know in certain insurers, they do have this practice where they feel like, oh, certain genders are more inclined to certain diseases, and then because of that, they increase the premium accordingly, right? So I think the ACA actually helps to stop that. And like I said, in the US, basically there are four main ways of getting your four main types of insurers: your employer-sponsored insurance, individual and family, which is through all these ACA marketplaces, Medicare, which is for the elderly, and then Medicaid is for the low-income families in the US, right? So where does Oscar stand in all of this? I think for Oscar, they primarily operate in the individual and family market through the ACA marketplaces, which is Obamacare or the Affordable Care Act. So they position themselves as this tech-driven insurer. They have this app that they produce and the digital tools to simplify the experience. And they make it easy for customers to select your plans, to schedule virtual doctor visits, and then they actually personalize recommendations based on the customer's data. And they do reward customers for healthy behaviors, right? So in their 10K, Oscar basically has stated that the plans in the ACA range, they have apparently 5 different plans ranging from catastrophic to bronze, silver, gold, and then finally platinum. And so Oscar actually sells insurance in basically 18 states in the US. In certain reports, I see them write 20 states, but from what I read over here, it tells me 18. So if anyone knows whether or not which number is the most up to date, you can let me know. But 18 to 20 states in the US, and I think yeah, and I think, sorry, I lost my where are my notes? All right, so so Oscar sells all these insurance in the 18 different states in the US, at least in 2025. Then on top of that, they also work with small group plans via partnership with Cigna and things like that. But I believe they're running off the members from their Cigna platform, right? And so they're also expanding into the employer flexible models, and that will be your ICRA, right? Individual coverage health reimbursement arrangements, where the employers reimburse employees for individual plans bought through the different marketplaces. So the employers basically give the employees a fixed sum that is tax deductible, and they basically use that to go and choose an insurance that is suitable for them. And I'll talk about the benefits, the pros and cons of both later on. So I'm going to show you a very short video. Okay, it's a very long video. I think you can see it down in the description. This is basically a podcast done by Mark Bertolini, the CEO of Oscar Health. But I just want to let you hear what he says about Oscar Health and their platform and their offering as a whole. All right, give me a minute. Right. So I'm going to be sharing the link to this entire interview. I'm not too sure how many people have watched it, but I'll just share a link to this entire interview down in the description of this deep dive. All right. Let me know if you can't hear it because I don't know how the sound is going to be like.
Welcome to Branded. I'm chatting with Mark Bertolini, CEO of Oscar Health.
Okay,
your business, you have...
I think I put 1 minute and 15 seconds. Let's go to 1 minute and 15. It's around here. Okay, let's listen to what he has to say.
People who are at certain levels of the federal poverty level, that brings more people in. And the most recent enrollment increased the overall pool to 24.2 million people. So those are the people we take care of. We do it uniquely in that we are the first platform, end-to-end health insurance platform that has been built since 1972. Everybody else uses the old one. It's called Health Edge, in their own version of it. And we are a cloud native, digitally oriented firm. So we have a lot of digital connections to all of our members. We're easier to do business with. Our brokers that sell the product, they are digitally connected. Our providers are digitally connected. We use extensively large language models and artificial intelligence to run the business more efficiently. And since I arrived in April, we have taken 1,400 basis points out of the operating infrastructure of the firm by deploying large language models. Why do we do that?
All right, so I'll leave you to go and watch that later on at the end of this to have an insight into how he thinks about the business and all that. But I think I'm going to be using this particular interview fairly often or in reference to it throughout this deep dive. And so later on, as I refer to certain points of this interview, I'll be giving you the timestamps for those references so that you can listen on later, right, at your own free time. All right, so let's jump back into our discussion over here. Right, so he basically tells us that Oscar's technology platform is differentiated in a way that there's no such end-to-end platform created in the US since 1972, which means all the other insurers are using a very outdated platform, right? So this was taken from 1 minute and 15 seconds into the video. And he says that everyone is using this old version of this old healthcare platform called Health Age or some version of that. And what they have done since he has came into his role as CEO is to drastically cut costs by implementing some of these AI solutions through their tech platform that basically cuts out all to make it a much more efficient platform. And so because of that, they actually shaved off 1,400 basis points from their operating expenses. And I think that is fairly impressive. And I think that is what we can expect and what we're actually seeing from him going forward from here. So their tech platform is called Plus Oscar, which is so weird. I keep calling it Oscar Plus when I'm actually doing my own research or when I'm talking about it. And I think one thing that he states over here about Oscar is that they have used all these large language models to make their platform more efficient. However, at the same time, you have to understand that this is an insurance business. And at the end of the day, sometimes when you use AI, the AI is still not 100% accurate. And so because of that, that can actually affect the customer experience as well. And so whether or not it really does remains to be seen. But I think if you consider the customer experience on Oscar, apparently people all over say that it is claimed that they are a very good platform. And that is actually represented by their net promoter score of 66. Now, I believe I read somewhere on X that this used to be higher in the 70s, I believe. But I can't find that post on X anymore. So if anyone can remember who or where this was on X, you can confirm it in the comments below. But right now, at least, it stands at around 66. Now, this is still a fairly impressive score if you consider the fact that the average net promoter score in the insurance industry is 0. Right, so I mean, to me, I see the benefits of using all these LLMs as part of their entire ecosystem, and to be able to offer their tech platform along with these built-in language models to their other healthcare competitors within the space, and basically generate another form of revenue from them. But at the same time, we also have to bear in mind that at the end of the day, insurance is still a people's business, and when it is so heavily people-oriented, I think sometimes when you introduce too much AI into the entire system, that can actually lower lower, the affection or the kind of feeling that people have towards you, because it becomes very artificial. So to me, the way I look at this Oscar Plus platform or Plus Oscar platform is basically, it sounds like SoFi's version of Galileo, right? SoFi has a banking business, a financial services business, and all of this is being supported by Galileo. So Galileo lowers the cost for them, and then after that, oh, my light died. Okay, came back on again. And then Galileo basically lowers the cost for SoFi, and then on top of that, they're able to license out Galileo to their other competitors. So similarly, what Oscar is doing is that Plus Oscar is powering their platform. They have developed it. They have added in all these large language models, and he spoke about training the LLMs on Oscar's data. And then now they are able to actually offer this out to some of their competitors, because the main aim here to them is to improve the US healthcare system. And so, of course, I think having invested in SoFi and having seen how they have handled the growth of Galileo, I think I take that same perspective when I look at this Plus Oscar platform. I think a lot of people are very excited about it, and I do think that it is worth getting excited about. But right now, I think the risks of this Plus Oscar platform is exactly the same as SoFi and Galileo, which is basically an adoption problem. So this is definitely something that is good to have, but I'm not particularly hyped out about its potential adoption. I will get excited when I see it, but right now it is not driving enough revenue for me to get excited about. So of course there is potential for their tech platform to grow into a significant revenue driver in the years to come, and that actually protects or gives them a more robust form of revenue. But at the same time, like I said, I will get excited when I start to see it. And yeah, and I think that if all the other healthcare systems are being run on a system that is built in 1972, I do think that there's a large possibility that they are going to be able to sell this. But right now, as Mark Bertolini would explain later on in the presentation, that their main focus is on building a strong insurance company first with the best customer healthcare. Now, we'll touch on that in the next section. Okay, so at this point, we know how Oscar works, why they are differentiated. But I think what made me increase my position or made me realize how they can actually win customers over is basically because of, I believe this, did I put it in? This statement. No, I don't have it. Okay, basically there's this statement inside their 10K where they spoke about seasonality in the US healthcare industry, where there are these things called, it's the next slide, this one. They have open enrollment periods, right? And then special enrollment period and things like that. And so what makes Oscar different from the other companies is that I think I need to explain to you my thought process over here. So we know that Oscar is different because they focus on making the entire insurance process very frictionless, and then they are basically focused on driving the best customer experience so that customers keep coming back and recommending their product to their friends and things like that, and that's how they hope to grow. And the evidence of that is their high net promoter score of 66, right? So initially, when I first started a position in Oscar, I don't understand how they can get more customers, because the insurance industry, at least in Singapore, is actually fairly saturated, I feel, right? And let me use myself as an example over here. See, previously I bought this term plan that lasts me until I'm 99 years old. Now, this term plan covers a fixed amount upon death, and at the same time, it pays out a fixed amount for disability and critical illnesses. So because I bought this plan in my early 30s, I think it cost me somewhere in the mid $3,000 range in premiums every single year, right? Now, however, someone buying the exact same plan with the exact same coverage in their 20s could get this same plan for around $2,600 to $2,800 in premiums. Do you know if Oscar diluted before? Are they usually diluting the stocks? Yes, later when we go through the valuation, you'll be able to see it. Somewhat dilutive, but not. But I think because they're still so small, I think it is expected. And I think in terms of if you're talking about dilution with respect to net income growth and revenue growth, it is fairly low, right? So later I'll cover that in the valuation process. So yeah, so like I was saying, my plan, term plan, covers me until 99. pays up for disability, critical illness, cost me mid $3,000 range per year in premiums. Someone else in Singapore in the 20s could get the exact same plan, exact same terms between $2,600 to $2,800. So this premium actually sticks with you for life, which encourages people to get insured early, and they basically can lock in these lowest premiums with the highest benefit. However, the problem is that this model that in Singapore doesn't encourage people to change insurers and doesn't promote much innovation within the space, right? Because in the US, when you have this open enrollment season between 1st November and 15th January, apparently you can choose any insurer and any plan that you want between that time to enroll into their program, and the coverage starts either on 1st of January or 1st of February the following year. So because of this open enrollment period, that's where if people are having a poor experience with their current insurer, they're likely to be able to switch to someone else like Oscar, which is unlikely to happen actually in Singapore. Because, for instance, let's say I'm in my 50s and someone else comes in with the exact same coverage and exact same coverage, exact same terms and things like that, but they tell me, you know what, we have a better app, our customer experience is better. But if I switch over, my premiums, instead of paying $3,000, which is fixed for life, I would end up having to pay perhaps $6,000 to $7,000. And so because of this hike in premium, I'm unlikely to want to switch over to the new company, despite them perhaps providing a better service. So which is why initially, before I understood this aspect of the US healthcare, it made me quite hard to invest in Oscar. What about Novo Nordisk? Okay, Novo Nordisk is slightly different. They're not really an insurance company. I can talk about them when I talk about HIMSS as well. Results for their latest drugs are not that fantastic. So fundamentally, I do have a concern with them. But if you're playing them for the bounce, then on the technical, if you're speaking about the technical levels, yes, I think people are playing them for a bounce. If you're talking about fundamentally, I think a lot needs to be proven to turn the company around, right? Or at least to show that they're not losing market share. But honestly, I don't know as much as I need to about Novo Nordisk. Much of what I've learned about Novo Nordisk has to do with their relationship with HIMSS and what actually came from that. So like I said, because to me, initially I didn't understand how a small company like Oscar could enter into the space and disrupt the incumbents. But now I know that, okay, there's this open enrollment period and people can sign up and switch plans without restrictions. So this actually puts pressure on the insurer to deliver the best value and service to their customers, and failing to do so opens the path for a younger company, more innovative company that focuses on customer experience like Oscar to disrupt the incumbents. Because like I said, if this was in Singapore, a new company coming in, despite their better service, because of my age, I would likely have to incur a higher cost to switch to them for practically the same coverage. And so it makes switching a lot less attractive. So therefore, I do see a way where Oscar can continue this rate of growth over time. And I think that if you track their net promoter score over time, that would be a good indication of how they're doing in terms of being able to organically drive their customer growth and whether or not they can keep up this pace of growth. So, like I said, I'll be the first to admit that perhaps my depth of knowledge in this area regarding the US healthcare might not be as nuanced as some of you who are actually staying in the US long term. So if I've made any material mistakes in the understanding that could affect this analysis, please do let me know down in the comments below. All right, so now at this point, I think it's also important for us to understand that when you are investing, especially in such a young company, certain parts of the fundamentals, things like Sergej was asking about earlier on, stock-based compensation and things like that. All these things might not be in the best shape if you compare it to some of the bigger companies. Right, but I think it's also important to understand that when you're investing in a young company, like a SoFi, when it was smaller, like a Palantir, you're not just investing in the company, but you're practically giving your capital to the management in order to allocate your capital. And you need to know that the management is common, right? Which is why when I, researched SoFi, before I decided to invest in SoFi, I looked at the background of Anthony Noto, of people like Chris Lapointe, Andrew Dudham for HIMSS, and even Alex Cupp. And so similarly, I wanted to know more about Mario Bertolini, as well as Mark Bertolini, and Mario Slotzer. And I think that there are a couple of interactions here between the pair that hasn't been spoken about enough online. And I think it shared a little bit of an insight into how both of them thinks about this business. You see, we know that Mark Bertolini was appointed as the CEO of Oscar back in 2023. However, their interactions between Mario and Mark did not begin in 2023. It began nearly a decade ago in 2014. Now, in 2014, Mario Slotzer heard this speech given by Mark Bertolini on transformative healthcare, and basically took that back to Oscar and shared it with his team back then. So he was already a fan of what Mark was doing at Aetna, and so when Mark retired from Aetna, Oscar Health actually offered Mark a position in basically on their board of directors. Now, at that point in time, Mark Bertolini actually declined the offer because he mentions in the podcast that he doesn't like the administrative side of being on a board of directors, a lot of PowerPoints and people talking at him. So that was where his head was at. However, he actually agreed to meet Mario and Josh on a regular basis to help them understand and navigate the healthcare and insurance landscape in the US. So when the stock fell from 39 to $2.50, which before doing this research over here, I never realized that it was at $39 before. Mario and Josh said, "Can we now meet you every week instead of at a regular pace?" And so because of that, Mark agreed to meet the pair of them on a weekly basis. And he actually revealed that this is how his compensation package is actually structured. And the exact quote from this podcast that I linked down below is that Mark told the interviewer, his compensation package essentially is get the stock back to that price, referring to the $39 per share, and you're a winner. And so by giving you this backstory, what I want to point out is that the appointment of Mark Bertolini is not a sudden appointment, right? But one where he all along had a hand in shaping the culture of Oscar, shaping the direction of how Oscar is growing. But right now, he's just taking a more official and active role in the company. And I really love the way that Mark Bertolini shared this story about how he actually taught Josh and Mario to negotiate deals with CVS on a regular basis, on a monthly basis, in fact, because during one of their interactions, he actually asked them, how often do you negotiate your deals with CVS? And they actually told him that we have 1 year left on a 5-year deal, basically saying that they don't intend to negotiate until it's close to the deadline, right? However, Mark actually, based on his experience, pointed out that it's actually important to negotiate pricing every single month to be able to squeeze out profit margins. And I think this really shows the dichotomy between the experience that Mark has and the product and tech-focused nature of the current team at Oscar, and basically how their strengths actually complement each other in the long run as they work together to run this company. And so when Mark Bertolini took over as CEO, Mario at that point in time had to step down and took on the role of president of technology. And I think this shows you a lot about what Mario believes about the company, about the vision, about the objectives of the company, really to change the US healthcare landscape. And I think this is something important to understand the vision of the founder, right? So it's not like the founder is no longer there. He's just putting himself in a place or in a position in the company where he's actually best suited. And I think it's not often that we see a CEO that is that aware and allow someone else to come in to do the running of the company, and then he's basically in his own element, being the president of technology, driving innovation in that particular area of the business. So there are a couple of things that made me feel like I could trust Mark Bertolini as the CEO of Oscar. So before he took the role, he basically asked Mario and Josh about their long-term objective, and he made it very clear that if all they were doing is to be in this to flip the business in future, which means to sell Oscar off to one of the bigger insurer, then he had no interest in being the CEO of Oscar and wasting his time. However, if the aim was to change the way they approach the healthcare in the US, then he's interested to bring on his expertise to help them develop Oscar into a leading company in the US. And basically, he views his role as one where he's helping the company put a plan in place to become one of the leading healthcare providers in the US, and at the same time establish a succession plan for when he leaves. So he was very clear with his strategies. There are 4 pillars in total. I think there are basically 4 pillars in total. The first one is to build a great insurance company. The second one is to give the best customer experience so people will choose to come back instead. And basically, what he says is, instead of we sell to them, they come to buy from us. And that is the mindset that he has when it comes to running his business. The third pillar is to extend their lines of business, which is exactly what they're doing with ICRA right now, and then to extend their platform, which is Plus Oscar, to others in the industry. So I think earlier on, Sergej was asking about stock-based compensation and things like that. I think when it comes to stock-based compensation, the exact numbers, we have to dive a little bit deeper into it later on. But for Mark himself, how his pay package is structured is actually quite interesting, because I don't think many people know this. And I think this really speaks to where his mind is at, where his head is at regarding running this company. So I think, as you know by now, stock-based compensation are redeemable, or these stock options are redeemable at certain price points. And on this podcast, while Mark did not explicitly review the price points of his stock options, he has already made reference to the fact that they get it back to $39 and you're a winner, right? So we can have an idea of where that ballpark is, but there are different levels where these options are vested. And for him, he chose his stock options to be vested at $1 above the employee stock options. And so that means for every level where these stock options could be exercised, the employees would actually benefit first before him. And I believe you can hear him say that around 8 minutes and 30 seconds into the video. And finally, the third story is one where he was recounting an incident when he was CEO of Aetna. One of the largest shareholders of Aetna at that point in time came in to his office when he was the new CEO, and he told Mark that he expected him to double the buybacks and increase the dividends over the next couple of years. Mark, in fact, told him point blank to his face that they're slashing the buybacks, growing the company, and keeping the dividends steady. Now, at that point in time, people around him, all the finance people, told him, if you don't appease this bigger shareholder, he would end up selling the company, and then his share price will suffer and things like that. However, Mark was proved to be extremely mission focused. Basically, he did the best thing that he could do. He decided the best thing that he could do at that point in time was not to appease the shareholder, but to really reinvest all of these profits into growing the business. He essentially told that largest shareholder to, GTFO, right? And if he, referring to the bigger shareholder, was unhappy, he could literally sell the shares, leave the company, because according to Mark, you choose your own shareholders by your actions. And so that's exactly what the bigger shareholder did. He sold Aetna shares at around $39 a share. And eventually, within a year or so, because of how well Aetna did, he had to buy it back at $109 per share. So I think after hearing this, it tells me that Mark Bertolini is someone who is extremely mission-driven. He has the experience, the capability, and the personality to lead a company like Oscar. He actually spent 10 weeks interviewing every single person within Oscar to understand where they feel is their biggest pain point and what he can actually do to help them solve this pain point. And so I think what makes me even more bullish over this company is that, Mark himself is self-aware that he is this 68-year-old dude coming into this young, innovative company, and how people perceive him as someone that is legacy, someone that is not keeping up with trends, and he has to take the effort to actually prove that and to be actually on the ground every single day and to have people see him running the company. And with Mario as well, he is also self-aware, knowing his own ability and where he is of most value to the company. And basically, neither of them are putting their ego over the long-term growth of the business. And therefore, I think putting all these things together really makes me feel like this management team is one that, I feel comfortable with, at least trusting with my capital. And I think this story about the interactions between Mario and Mark, the way that Mark came online, the way that he plans to run the business, it's not something that is usually covered online. People just tend to talk about this $12 billion revenue number, how much profit they're going to make, and then you apply a certain multiple. But I think, like I said in every single video, it's not just about the revenue number. It's not just about the net profit number. Because if that was the case, analysts who have access to the most information will be able to do much better than us all the time. But we know in 2025, retail is beating Wall Street this year, because a lot there's a lot of fundamental analysis to do with numbers, but at the same time, you need to understand the people that are on the ground running the business. And I think if you don't understand that, it's very hard for you to end up putting a dollar to that if you're just using purely revenue and profitability numbers, right? So it's not that those are not important, but that has to be in combination with the people running the business. You have to bear in mind that the people that are in the CEO seat, in the leadership position, need to be able to hit whatever profitability metric that you write on your Excel file, because all you do is change a number, but you have to believe that the people in the hot seat can achieve that number that you have keyed into your Excel file. And so that's why, to me, I think understanding the management at these levels is actually very important, especially when it's a smaller company. So since we are talking about the stock price, I do want to let you hear what Mark is actually saying about this stock. Like I said, you can watch the whole video for yourself later on, but I just want to share a very, very small segment over here before we carry on. And right now at this point, when I'm pulling up the video, if anybody have any questions regarding Oscar Health or anything I've said so far, please do let me know. All right, I believe I wrote this was at 20 minutes and 6 seconds in. Give me a second. 20 minutes and 6 seconds, around here. Okay.
Are you on your journey now?
We're through in 2025. Our objective is to have so we made money in 24 for the first time. We made adjusted EBITDA in 23, which is what we told the street. But in 24, we actually made EBIT. We made real money you can count, right? Instead of funny money. And so that kicked it off. This next year, we've promised 2.5% margins to the street in our earnings through the year, and growth of up to 11 billion in premium. And why those two numbers matter is that 11 billion at 2.5% margins in the insurance industry generates a $5.5 billion market cap. We're at 4 point something right now, 4 point low, right? So that's one piece. At 5% margins, you get a 1x of revenue. And so by 27, what we committed to the street is we're going to have 5% margins, real margins, not EBITDA, EBIT, and we're going to have 14 billion in revenue. That makes the stock price of the company somewhere between $45 and $55 a share, depending on the PE multiple from where we are today.
You've talked about what you've shared.
All right, so I hope you heard what he said, and basically let me break it down for you. He's telling us right now, today, that Oscar is currently trading today. If I look at today's price, I believe it's around $4.3 billion in terms of market cap. If Oscar puts up $11 billion in revenue, which we already know that they plan to put up $12 billion in revenue, with 2.5% margins, they should be worth $5.5 billion, which represents a 27% upside from here, putting it at around $21 to $22 per share. Now, the caveat over here is that we already know that this year, because of the mispricing in the ACA and all of the headwinds, I think Oscar is not going to be profitable this year. They're not going to be able to deliver that 2.5% margin. But this is not an Oscar-only problem. This is an industry-wide problem. And later I'll be talking a little bit about what happened with the ACA. But I think what this tells me is that once this clears up, this projection by Mark Bortolini is still going to come true. Now, instead of $11 billion, it's going to be $12 to $12.2 billion in premium at least, with a 2.5% margin, right? So $5 billion in market cap, around 0.5. So if they are worth 0.5 times of revenue at these margins, at this revenue, then at $12.2 billion, call it $12 billion, they should be worth $6 billion in market cap, which means from 4.3, you're getting closer to 40% upside from here. So this is what he thinks. And then going on from that, he tells us that the plan in 2027 is to get to 5% margins. And why this 5% margin number is important, it's because of the multiple that comes with being an insurance company that operates at a 5% margin. Now, at this point, they should be trading at 1 times of revenue. That is why a lot of the accounts that I see, or a lot of the people that talk about it, they tell me, imagine this when this is 4 to 5 times sales. And apart from Lemonade, I don't think there are other insurance companies that are operating at that level. But again, Lemonade is not really operating in the same space as Oscar. So to me, this low price to sales multiple is basically how the insurance industry is priced. And their plan is to get to $14 billion in revenue by 2027. Now, that is with the assumption that they made $11 billion in 2025. Right now, in 2025, the revenue expectation is 12 to $12.2 billion. And then they are actually raising premiums in 2026, which again, later on, I will be covering that. So it is safe to say that if they were expecting 11 billion in 25 and 14 in 2027, if they're expecting 12 in 2025, $12 billion, they are going to be expecting more than $14 billion in 2027. And so if they do hit this $14 billion number at a 5% margin, then by right, the street should be giving them a multiple, one times of revenue, which puts them at $45 to $55. Now, the thing that you have to understand about the stock market, that it is always forward looking. So I do get it, this year they're not going to be profitable. But once this year is coming to the end, people are starting to look forward to next year. Oscar has raised premiums, I believe, by around 20 to 21%, already approved in most states. People are going to say, hey, wait a minute, this company is this company is going to be, raising their premiums in the next year. They're going to be generating more than $12 billion in revenue, because 12 billion is 25. I believe 26 will be more. They might be operating at 2.5% margins then. So it's safe to say that, the stock market might start to price this in going into next year, right? So I think that is where this company really interests me when you look at the valuation from that perspective. And then I think this is something that is definitely worth looking at and worth following. And when I look back at numbers like what UNH are operating at, I do see similar trends. So I think what he's saying is really not out of the realm of possibility. Now, the problem right now, like I said, is currently over 90% of Oscar's revenue actually comes from the ACA, right? And they also do participate in they do participate in small group plans and employer flexible plans like ICRA, and they use ICRA in a way to diversify their business away from the ACA marketplace. And so because of that, I think people do see ICRA as a way of Oscar actually making their business more robust, right? As long they're basically expanding their markets by entering into ICRA, and they're actually also de-risking the fact that they are being so reliant on the ACA platform right now. So you may want to check out the interviews. Justin, CEO, interviewed here at least 4 to 5 quarters already. All right. For LifeMD, I'll definitely be looking at the interviews. Actually, I saved some of the interviews from YouTube. I just haven't had the time to watch it yet because I'm preparing for this week. Right. So when we speak about LifeMD, I'll be referring to those interviews as well. So therefore, in 2025, I think I believe sorry, where am I? In 2025, there's actually this scheduled expiration of the enhanced premium subsidies for the ACA. This is expected to happen in 31st December 2025. I think the general worry over here is that the Trump administration will choose not to extend these benefits because they want to cut the budget. Okay. However, from what I've come to realize, it's actually not so simple to actually cut the budgets, because it has political consequence as well. Because according to reports from Politico, 76% of the ACA membership comes from red states. And so removing subsidies at a time where people are dealing with the effects of inflation. I know Trump is claiming that, he's not the one that caused inflation and things like that. And we are not trying to argue that, but I'm just trying to say that right now, if 76% of ACA membership comes from the red state, sorry, I just got a call that I have to take. All right. Yep. So like I said, I think the point here is that people are worried that Trump and his administration will not be renewing these subsidies. But like I said, it's not so easy, because once they stop renewing these subsidies, they could take a hit in the midterms next year. Now, in an interview with Politico, Mark Bertolini basically told us that where is it? Yeah. He basically tells us that he feels like, if they don't do it, they're going to be hurting their own constituents going into a midterms. And I don't think that is something that Trump wants to do. So I believe people will be telling him, hey, perhaps you might want to ease off on this. And I think recently we have had news about the possible phasing out of this, and it's not going to be a one-time, just cut the subsidies totally. And let's say the subsidies do go away, and I think if you extrapolate from this, that is where people start to be a little bit more afraid of what is going to happen, because I think the downside or the risk that comes with an open enrollment period, unlike Singapore. In Singapore, once you get a plan, usually people stick to the plan for life. But in the US, because there are all these open enrollment period, it's likely that people who are healthy, and if the healthcare cost goes up, may choose not to renew for that one particular year until their financial situation is better. And so if you extrapolate from this, the expectation is that, people who are healthy, they are less likely to want to pay higher premiums for their health insurance. And so this means that the people that are likely going to continue on with the insurance despite the rise in premiums are perhaps a sicker cohort of people. Right? And as a result, that will lead to a higher medical loss ratio and essentially squeezing their margins. And so the entire health insurance industry in general misjudged the morbidity rate of the ACA. And I think because of that, the explanation, or at least from what I found, the explanation is that they did a pricing in 2025 based on 2024 data and extrapolating from there. And the main issue is that many of these insurers, Oscar included, did not expect a higher average morbidity, neither did they expect this higher utilization trends which persisted from previous years. I think they felt that it would have normalized by now. And so if you take a look at their Q2 2025 earnings, this resulted in a medical loss ratio of 91% for Oscar, much higher than the 79% that. And so this is basically the extension of what they're afraid of, right? People are worried that you misjudge the morbidity rate, and then this will actually start to rise, especially because the healthier people are leaving your platform and the sicker people are actually staying on the platform. All right, give me a second. All right, let me quickly finish this part. I have something very to take care of in a bit. Then I might need you to give me a minute to settle this. Okay, so that is what the fears over the ACA are. I think people are worried subsidies are not going to be extended, and then once they are not going to be extended, healthy people leave the platform. And then with the sicker people on the platform, it's going to be harder to project out this morbidity rates now. And then the fears are that we are already seeing this mispricing in 2024 and in 2025, whether or not we're going to see the same thing happen in 2026, which I believe to be quite unlikely. Like I said, they actually already gotten approval of increasing their premiums by 20 to 21%. Right. So I believe they are very much prepared this, and later on as we discuss the valuation, I'll be showing you as well that Oscar, through the intervention of Mark Bertolini, has taken steps to actually cut costs quite aggressively going into 2026, and they do expect to return back to profitability in 2026. Right, so you can see over here UNH, and I think what's that? What's CNC? I can't remember what's the name for CNC. Oh, Centene Corporation, right? UNH Centene, they have increased their premiums next year by around 26-27%. Meanwhile, companies like Oscar and Elevate, they basically increased by around 20 to 21% on average, closer to industry averages. So you can see that they are already taking steps to mitigate against this, and I'm sure that they are caught off guard this time round. They tend to be they will be a lot more conservative thereafter. And so as they increase premiums, and if people continue, more people stay onto the platform because the subsidies are not basically cut in totality, but they're more phased out over the next couple of years, then I do think that we can actually see a higher level of profitability that we expected initially, right? So one of the bright spots for Oscar is really them getting into ICRA, because this has been highlighted as a potential way that they can hedge against the risk of being in the ACA. So ICRA basically allows employers to reimburse the employees on their individual plans, and they can do this through a tax-free reimbursement. And this actually expands Oscar's total addressable market. So if you take a look at this graph over here, this basically shows you the traditional ACA market. But when you add in the small medium businesses employers, you can get up to at least a 5x in terms of individual market TAM. And so in terms of the lives that we were talking about 24 million people on the ACA platform versus 96 million people if you include the ICRA market, or basically any of the businesses that have less than 1,000 employees. So Oscar has already acquired assets to build out their ICRA offering, including a brokerage as well as an enrollment platform. And so it's launching its ICRA. I think it has, there's this news recently. I'm not too, to be honest, I haven't really read much into it. I just know that they have launched an ICRA product with Hy-Vee, this retail brand. Got people excited, don't really know why. Yeah, but this is really something I need to look more into about how ICRA is going to help them. I do understand that from Oscar's point of view, because they are serving the individual and family markets, as people perhaps not choose to go on to the employer-sponsored insurance programs, they are definitely able to, and as they come into the individual and family marketplace, which is in the ACA and things like that, then they're definitely, that's where Oscar really shines. That's when Oscar really has the ability to continue to grow their TAM and to reach out to more customers. And so I think what Mark points out, one of the benefits of ICRA is that it makes things a lot easier for the employers as well, because they don't have to worry about renegotiating the deals with the big insurers. They don't have to worry about rising costs due to certain medical claims that occur throughout the year. And I think from the employee's perspective at the same time, you are not just limited to the plans that your employer have negotiated with the insurer. You can choose a plan that is more suitable for your stage of life. So I wasn't too clear what this means until I listened, or when I did a little bit more digging. On one of the CNBC interviews, he was saying that, for a young person, right, perhaps if you go with an employer-sponsored plan, you only have 3 choices. However, you might want to choose a plan that is cheaper and have higher deductibles. So you know that you're healthy, it's unlikely you're going to make use of the insurance. However, you do not want to completely forgo it. So you end up going with a cheaper plan, but you're okay that should you need to use the plan, you pay a higher deductible. Right. So this plan may not be part of the negotiated lineup offered by the employer. And so in the end, what this means is that the employee tends to have to just make do with whatever plans that are available that might be above their budget and they don't need it, right? So they may be overinsured. And at the same time, he also gave an example from the employer's point of view, especially if you're in a smaller work environment with less than 1,000 members. Even things like pregnancy in a year, which is any pregnancies that happen within that particular year, which is something that should be celebrated, would end up in an increase in rates every single year for the employer. And so because of that, something that's supposed to be celebrated becomes something that the employers are worried about. And I think he feels like that really shouldn't be the way healthcare is in the US. And I really do applaud that kind of mentality for wanting to improve the healthcare system. Now, the only thing to take note is that the ICRA adoption right now is still emerging and is unproven at scale. So I think success in this area really depends on employer uptake and regulatory support. So this is something, like I said, when we do our evaluation, that's why I'm giving them a wider margin of safety when I value Oscar. All right, so we come to talk about your earnings. Can you give me 2 minutes? I just need to pass something to someone at the door. Sorry, like you guys have eBay. Singapore, we have something called Carousel, and someone wanted to collect something tonight at 11:45. So they just came. Right. So in US, in eBay, I think you ship it, but in Singapore, because we're so small, people actually come to your place or near your place to collect it. And I think, yeah, that's that's an interesting part of selling on sites like eBay, and that's the differences in the different geographies that we are in. Yeah, so let's go back to Oscar. Give me a second. All right, where are we? I'm so sorry about that. Let's get back to this. Okay, so with Oscar, let's dive into their numbers of their Q2 earnings. Now, their total revenue came in at around $2.8 billion this quarter, with a medical loss ratio, you can see over here, 91% versus 79% a year ago. Like I said, this is due to, I think, the insurers just in general, not expecting a higher morbidity and utilization rates, and they expect this to normalize to a lower level ever since the last couple of years. So because of that, that is where a lot of these insurers find themselves caught in this position with a higher than expected medical loss ratio. And as they increase premiums, this is going to be a lesser of a problems going into the next subsequent years, right? So they kept their guidance of $12 to $12.2 billion in 2025, despite the net loss over here. So this really signals confidence in growth. And I think recent analysts and reports have discussed the potential for subsidy extensions for the ACA, or at least, like I said, the possibility of these enhanced subsidies being phased out rather than immediately cutting them off on 31st December 2025. So it's important to note that right now, all these are still discussions. There are no definitive extension plans or phase-out plans that are being announced yet. And I think the fears still do persist amid all these policy uncertainties right now, right? But that is something that we have to pay attention to. And you can see the member growth over right at the bottom. That has been fairly strong, 1.58 million members last year compared to 2 million members this year. I think if you look at it on a quarter-to-quarter basis, I think because of certain special enrollment periods and things like that, you tend to have a lot more volatility in the number of member additions if you look at it on a quarter-to-quarter basis. So which is why for this kind of insurance companies, I prefer to look at their member numbers on a year-over-year basis, right? So later on when I take you through the valuation, you're going to be able to see the quarter-over-quarter numbers, and you can see how volatile it is. But then I think we really need to focus on the year-over-year numbers over here. And the year-over-year growth for Oscar is actually fairly strong, right? 1.58 to 2 million members. All right. We have already covered this. Okay, so finally, before we get into the valuation, just wanted to quote certain things that Mark has told us during the earnings call. So they are reducing fixed cost headcount. We expect these actions will eliminate approximately $60 million in administrative costs for 2026. And they also improve their 2025 SG&A guidance by 50 basis points, right? Give me a second. I need to check. Okay, done. So basically, they're telling us that, hey, apart from raising premiums, we're also taking the defensive steps in cutting our headcount costs. And both of these added together basically will end up returning us back to profitability in 2026, right? And they do believe that their ACA marketplace, along with ICRA, will drive a more stable risk pool over the long term. And I think a lot of this, I think if you are unsure about the insurance industries, it can be a little bit daunting to think about. But I think if you know the correct metrics to track, I think this can actually be quite an interesting business over the long term. So let's take a look at the valuation. Let me just share with you the Excel file over here. Before we get into the valuations, does anyone have any questions? All right. Okay, so what you are going to notice, okay, is this too small? I think it is, right? Let me just expand this. Let's go to the business and then let's go in. Okay, so like I was saying earlier, if you take a look at, where is it? If you take a look at some of these numbers over here, you're going to see that the member growth numbers on a quarter-over-quarter basis is fairly inconsistent. But if you look at it on a year-over-year basis, it is actually very, very impressive, right? So if you take a look here, year-over-year, been growing 98%. Let's if we take a look at all the Q2s, right, of 84% in Q2 2022. This dropped slightly to 900 million in 2023. That's when Mark actually took over, and then you can see in 2024 grew by 62%, and then this year they grew by 28%. So it's fairly strong, if not a little bit lumpy revenue growth, and you can see why they really need Mark to come in. And since he has came in, you can actually see that he has driven pretty strong revenue growth over the last couple of quarters. And then the line at the bottom over here is the premium collected, so that you can see the premium collected per member. So what you notice over here, I'm not tracking the active members compared to the number of members that are added, which is what I usually do. This line over here is the number of members on Oscar's platform. The blue bars over here represents the number of members on Oscar's platform, and the orange line represents the premium collected per member. And so you can see that has been steadily increasing since 2021 until where we are today in 2025. Now on the right hand side, I forgot to label this chart. This is basically the medical claims number. And what we have over here is the medical claims in terms of a dollar amount being paid out. Now, what I really want to point out over here is, if you can see how this actually works. And I know people are actually complaining about this. They're saying that, why is it that their medical loss ratio is always increasing throughout the year? I think you have to understand that how this happens in the insurance industry is that they keep the premiums, and then around 80 to 85% of it needs to be paid out, right, in the US. And so, they can't just pay out 85% every single quarter, because certain quarters there are more claims, certain quarters there are lesser claims. But as long as they average out over 80 to 85% throughout the year, generally that everyone is fine with that. And so because of that, what you see is that usually the start of the year, they give you a claim of lesser than 80%. They pay out lesser than 80% in terms of a medical loss ratio at the start of the year. But towards the end of the year, you can see that they get into the high or 90% range. And so this becomes a very cyclical aspect of their business that you have to understand. So it goes like this, right? The premium, the medical loss ratio will start off low, will increase towards the end of the year, and then come into the new year, it'll come low again. And then it's just a cycle. But what I want you to take note of is the long-term trend over here. If you take a look at the long-term trend of the medical loss ratio, it is actually coming downwards. Now, the only thing is this spike over here in Q2 of 2025. You can see usually this is supposed to, by right, this should either maintain at the same level as they were previously, or at least start to come down slightly, right? So we expect this to be, around this red line that I've drawn over here. However, this has gone above it, and that means that, in future quarters, we expect this to go up even more. And that is why, in essence, Oscar Health is actually being sold off. Okay, some people say it's a bit small. Let me zoom in. Yeah, so you can see it's cyclical, but it's cyclical in a downward motion. However, there's a break of that downward trend in this most recent quarter, and people are worried about it. And that is why Oscar stock has sold off since it actually hit $21, $22 a couple of months ago. right? And so that is how I understand the medical loss ratio, medical claims, and yeah. Let's look at the quarterly numbers. Okay, again, let me zoom it in. Okay, I'll just basically what I do over here to make it easy for myself is I calculate the premiums collected as a percentage of overall revenue. Now, the reason for that, majority of the revenue is collected, but they do have a smaller aspect of their business, which is the revenue they get from Plus Oscar, as well as the investment revenues that they actually make. So that's a very small part of their business, right? So that's why you can see the discrepancy over here between premium collected as well as revenue, but you can more or less see the trend of premiums collected is around usually between 97 to 98% of overall revenue. So, like I said, if they do eventually manage to scale their Plus Oscar platform, that is something that is going to be able to diversify away from their business away from just being purely insurance based. And hopefully, if that happens, we see premium collected as a percentage of revenue perhaps drop to the low 90s or high 80% range. And I think that would be a good mix for an insurance company with a tech offering as well. Okay, so you can see the drop in margins over the last couple of quarters. It was positive just last quarter, and then this quarter they have turned negative, right? So if you take a look at the graph over here, it doesn't look pretty because it is a new company. I think when I was investing in Palantir, I also had to deal with graphs like this. If you take a look at revenue growth, revenue has been growing fairly consistently over the last couple of years. However, you can see that growth rates have drastically slowed. I think in the most recent quarter, they grew at around 29%, right? So previously, they were much faster in the 50-40% range, but that has slowed down in the most recent quarter. Then that's what you're seeing over here. Operating income, and net income, you can see it's fairly consistent. There were certain quarters where they were profitable, like for most of actually, in fact, in 2024 they were full year profitable on an EBIT basis, and then I think in 2025 they expected it. You can see I think what you need to understand when you're looking at such cyclical companies, you have to compare them point to point. So, for example, Q1 2024, Q1 2025, you can see there's a jump over here, right? So depending on the cyclicality of their profitability, that's how I actually measure it. And I think it's more clear when you look at the free cash flow at the bottom over here. But basically, my point is that you can see that in 2024, they barely turned profitable, and in 2025, they were supposed to extend that. So in Q1 of 2025, they looked like they were on track to actually extend that. However, you can see suddenly they became highly unprofitable due to due to all this misjudgment in the ACA marketplace, right? So let me bring you down over here to this graph where we look at the free cash flow, and this is what I mean by you have to understand the cyclicality of the business. What you notice is that in the third quarter of every single year, they have a large expense in terms of free cash flow. So there's a negative free cash flow, and then after that it goes up Q4, Q1, and then after that it drops again. And then you can see this trend happens once, twice, thrice, and then most recently 4 times. And what you are noticing over here is that despite there being volatility, each time, during the 3 quarters that they are free cash flow positive, this is going up. This is going up relative to last year. This 3 is also going up relative to last year. And so that is what I mean by sometimes, by nature of the business, the cash flows are cyclical. Doesn't make it a bad business. You just have to find certain patterns and to see them repeating and going up in an uptrend, right? So people may look at this and say, hey, negative free cash flow, but you have to realize, oh, this is actually a pattern. And if you look at a pattern, gradually year on, if you look at the data as a whole, it is moving in the right direction. Right, so I know this is very different from what we usually see with tech companies, where tech companies, free cash flow is just one straight line up all the way. But that doesn't mean that this is a worse company. You just have to understand the nature of the business, right? I haven't looked into why free cash flows are so low in Q3. I think a lot of that to me might have to do with the amount of premiums that they pay out and a lot of marketing that they do, because in Q4 in November, that's when the open enrollment season takes place, and I think that's when they actually want to drive marketing in Q3 in preparation for that. But I haven't really looked into why is there such a cyclical nature of their spending, at least in Oscar Health, and whether or not this is industry wide. So if anybody knows, you feel free to let me know. But like I said, don't be put off by the negative cash flows as long as you can spot a pattern in going up. All right. And then, okay, so basically, if you look on the discounted cash flow basis, what you see over here is that what I'm using is $12.1 billion in terms of revenue in 2025. That's my expectation, which represents a 34.9% year-over-year growth. So why $12.1 billion? That's because Oscar has told us that they expect to grow revenues between 12 to 12.2. So 12.1 is basically at the midpoint. And then basically I'm expecting 10%. Now, how did I get this 10% number? We don't have an estimation so far. Previously, they said around $14 billion in 2027. That's in terms of premiums collected. So I'm expecting slightly more than $14 billion when you add in the investment income and things like that. And presumably, since they did 12 in 2025, they should actually do more than 14 in 2027. But for now, I'm comfortable using 10% year-over-year growth. Now, one very key aspect is that when you listen to Mark Bertolini on that podcast that I shared down below, one of the things he said is that he referenced this CEO that always guided at 7% and beat revenues by giving 17% revenue growth, and it basically shows you how he likes to run the business. He likes to give lower than expected. Basically, he likes to send back guidance and then basically beat guidance consistently, and that's how he likes to run his business. So who is to say that this number cannot get even higher? But let's just say we are using these numbers basically from what he has told us. We don't do any of our own assumptions. And then cash flow from operations. I know previously you have had high cash flow margins, but let's say they don't really improve margins from here. Margins stay the same, between 3 to 5%. CapEx spend has been fairly low, so I think 1% is quite fair what we have. And then if you go down, okay, cash, I have given them $3.5 billion in cash. Now, why? Let me just show you. In terms of their cash on hand, do I have it over here? Let me see. Oh, okay. Let me share this page. All right, so you can see this is their most recent earnings in June. Let me zoom it in so you can see. Okay, I'm going to show you. Oh, sorry, this is their. Where is it? This is their earnings. Oh, sorry, is this share this tab here? Okay. What you're going to notice is that they have cash and short-term investments of $2.5 billion over here and around $900 million. So that is what you see in the cash. Then you have benefits payable of $1.5 billion, right? And then on top of that, long-term debt around, let's call it $300 million. So this actually shows you that just looking at their cash on hand, they have enough to cover all of their benefits payable plus their long-term debt. So for me, when I did the discounted cash flow, in the past, benefits payable, this segment is only there for insurance companies. It's not there for other companies like we have done previously with Nike and things like that. So that is why I'm actually counting this benefits payable as debt as well, that they have to actually pay out as part of their cash. So that's what I've also done when I used my discounted cash flow. That's the only difference I've accounted for in this valuation compared to what I've done previously, right? So let me go back to the valuation model. So we are over here. So you can take a look, right? So with that cash, you can see the two numbers that are being added at the top. And then similarly for debt, I'm adding the benefits payable as well as the long-term debt number, which is over here at the top, right? So with that, equity value around $10 billion, shares outstanding is basically given by given by the data in Microsoft, and then that gets you a share price of around $42.02. Now, in terms of their EBITDA margins, I'm expecting around 15%, which is more or less the low end of the margins for healthcare companies in general. And EV to EBITDA multiple of around 7. Why 7? Very simple. If I show you, let me show you. Where's my Oscar? Is it this? Is it this? I think it's this. Hi, Raf. Well, you're definitely welcome. I also really like this company, so I was also curious on how well they're doing. So I'm doing myself a favor as well. So thanks for asking me to do a research on this company. All right. So if you take a look, I was just looking at this on fiscal.ai. You can see apart from Centene, everybody else tends to be trading at around 10 times EV to EBITDA. Now, Oscar and Lemonade currently right now, they are actually negative because their EBITDA, they're not EBITDA positive at the moment, right? I think Oscar is a more recent development, but you can see for the other companies in the space, around 10 times, I would say is fair. If you consider Centene at 3.8 times, you get an average of perhaps around 7. That's how I end up with that number. And you got to bear in mind, sentiment regarding the healthcare industry is really at the all-time lows. That's why you see UNH is at the place that it's at right now and things like that. And even then, they're still trading at a 10 times EV to EBITDA, which means that in future, they could actually perhaps be trading at a much higher valuation. But we are not taking all of that into consideration, right? We are just using the numbers that they are trading at today, which you can decide for yourself whether or not you think United Health is undervalued, right, at these numbers. So to me, I do think that they are, which is why I feel comfortable using these numbers in my valuation process over here. So that's why if I go back to the screen, you can see that's why I use a 7 times EV to EBITDA multiple, and then that gets you a higher share price, right? $85. Now, this perpetual approach why there's a big variance, at least to me, is because you have seen the cash flow of Oscar. It's a bit cyclical, so it's a bit hard to predict the cash flows. That's number one. Secondly, they are a very young company. They haven't really optimized their entire business for free cash flow. So that's why the assumptions over here are vastly different. But even then, that gets you an average over here of around $63.84. Now, depending on your comfort regarding the situation around the AIA, around the ACA, as well as the possibility of them going into ICRA, I think analysts are definitely excited about Oscar going into the ICRA marketplace and expanding their total addressable market in that marketplace. However, like I said, you'd have to be aware that, the ICRA still isn't fully scaled out yet, and you don't know how many employers will really switch over to this plan. So adoption may take some time. So if that's the case, some of you may feel like, okay, I want to give this a 20% margin of safety. Even then, the price target should be closer to $50 per share, which is actually just nice in line with right at the midpoint of what the CEO, Mark Bertolini, said, right? In 2 years' time, if we get to $14 billion with a 5% margin, trading at 1 times price to sales, $51, right? Which is basically in the ballpark of what he has told us before. So based on that, I do think that the valuation of Oscar is pretty compelling. In terms of my WACC, I've actually used 10%, right? I used a higher number. Even if you want to give it a 12% WACC to be very conservative, you still get $47.70. So I think that is why, if you look at it from a valuation perspective, that is why people tend to think that this company is undervalued based on where it is. I do think so myself. I do appreciate the risk that the healthcare space in the US is a fairly complex space, and it's not easy to understand, and it is very, very volatile towards regulatory changes and policy changes, right? And so that is something that you have to pay attention to if you're actually making this one of your investments. Okay, so that is something that we have to take note of. And then let me go into assessing Oscar, right? Thanks to all 12 of you for being here. I apologize earlier on because, of someone coming over to grab something from me when I was explaining the difference between the ACA and ICRA. So if you have any questions, please feel free to leave them down below, right? And I'll get to them right at the end once we are done with assessing this company. Okay, let's go to the framework, share screen. All right, so the first thing I need to do is to, sorry, this is from yesterday's new banks. Make a copy. Yeah, this is new bank. Shift this to the end. Okay, today we are doing Oscar. All right, so with Oscar in the insurance space, $16.50. Let's take a look. Total addressable market. TAM is, well, the TAM is increasing, especially if you count ICRA. So giving them full marks for that. Is the total addressable market evolving? I think healthcare is always going to be growing. Is it growing at 10% CAGR? No, I don't think. Is healthcare in the US growing at 10% CAGR? Yeah, it's not, right. It's projected to grow only around 4 to 5%. So, however, when we are looking at the evolution of the total addressable market, it's not just about how big the total addressable market can grow. The second portion of this is about talking about the new use cases and disruptions. And I think with Oscar being one of the younger or newer companies in this space, I think as they optimize the customer experience, I think the new use cases, the new verticals are not necessarily coming out with groundbreaking plans that other people cannot have. But I think it's the customer experience that is the way that they're approaching the healthcare system. I don't know. It's a big market, so you don't need a high CAGR, right? So I think that is where this TAM. Yeah, I think I'll give them. I'll take off half a point for that. And I think this is something, like I said, I might have to relook at when I redo this process, because I think Oscar, I wouldn't actually say that Oscar is a compounder because they're still so young, which is why you can see at the bottom, if you see at the bottom over here, I have this list that says the potential 10x checklist, because I am aware that certain companies are not supposed to be in the compounder bracket at the moment because of how young they are. And I think Oscar fits into these category where they should score, I would say, pretty poorly on the compounders checklist, just based on my own assumption. Yeah, because they're still a fairly young company. So I think because of that, that's why I came up with this potential 10x checklist, which is not going to replace the compounders checklist, but basically I'm going to use the formulas in such that you can pull up each individual checklist based on the company that you are valuing, right? And I think that will make it a lot more accurate when you look at different companies. So is the business model simple? I mean, it's an insurance business. Of course, it's simple. Is there switching cost? I don't know. You guys tell me in the US. Do you think there's switching cost? I mean, I would think that there's no switching cost. Of course, people don't switch off Oscar because of their brand value, but there's no switching cost per se. I think in Singapore, insurance has a switching cost, right? Because once you are stuck with an insurer, even if you don't like them, generally you're stuck for life, because if you change, you are basically repricing your own premiums based on your age. So I would say no. If you differ with me, please let me know. Network effects, I would say strengthening clear mode. I think the more people use their platform, the better they get at underwriting. So it's nothing to do with So it's not really so much of the people getting to know more of Oscar, that kind of network effects. I think there are some effects over there, but I think the more important part is that as they expand to serve more of the ACA marketplace, as they get more into the ICRA marketplace, and more people come onto their platform, they're definitely going to be able to better underwrite some of these insurance policies. Do they have a low cost advantage? I would say yes, because they are running using their own platform, and then they're actually offering this out, right? So imagine it's the same concept as SoFi. I'm owning the tech platform that runs my business, and then after that, I license it out to other people. Strengthening clear mode, I do believe that Plus Oscar still has room to grow. Economies of scale, I think this, like I said, all insurance companies, once you get to a certain level, there are economies of scale, right? I think right now, they are smaller compared to some of the bigger companies, but to say that they do not have economies of scale would not be accurate as well. If there's a 0.25, I might want to give them a 0.25 because it's not a strengthening and clear mode. But I think the fact is that because they have so many people already on their platform, and then as they expand the marketplace, they expand the risk pool, they're better able to price as per the risk pool, and then that actually gives them the ability to offer better premiums, more competitive premiums relative to some of the other competitors. Regulatory framework, in a way, yes. There's is it a moat? Honestly, I wouldn't say it's a moat. There are regulations that help them, but the regulations that help them would likely be helping their competitors as well. So there's no particular regulation that only helps them, right? I think when you're talking about regulatory framework as a moat, it'll be something like PayPal being able to operate in China, right? Compared to perhaps Block, which owns Cash App, right? So Block doesn't have that license to operate in China. That's a market that is close to them, but that PayPal has. So that is a moat that PayPal has that perhaps other payment companies may not have. So that's what I think about when I talk about regulatory framework. It's not that whether or not how affected they are by regulation, because whatever changes made to the ACA subsidies, whatever changes made to ICRA, that is going to affect other companies in the space as well. So to me, that's a 0. Intangible brands. Now, this is where, you see, maybe I really need to give, I don't know. 0.5 seems too little. 1, definitely not to be the case. I think I would like to give a 0.75 over here, which I don't have that. So that, like I said, this will be reworked again. But generally, I think I'm fairly happy with this 0.5, right? People know about them. They are actually growing in terms of their awareness, which is why you can actually see the member growth so quickly. The net promoter score is high and things like that. Growth faster than TAM. High growth, even now they have been over 30%. Even recently, the most recent quarter, the slowdown is 29.8. So I'll still give it to them, 30% and over. Multiple scalable revenue streams, one dominant, right? And like I said, this is just the nature of the business. This doesn't make it a bad business, but it's just the insurance business. In fact, I would say that once you start to see their tech platform come in, that's when you can say multiple scalable revenue streams, pivoting into new TAMs. But for now, one dominant stream. No customer accounts for more, moderate gross margins. Are they moderate? Actually, their gross margins are pretty high. 50%, let's say, high gross margins. Strong cost control. I think Mark Bertolini really has implemented strong cost control over there, so not too worried. Debt management, we have already seen. Low goodwill, net cash, definitely, even if you account for the benefits payable, so no problems over there. And then free cash flow. It's not negative. It's positive and growing. Like I said, cyclical, but positive and growing, right? So no issues for me over there, honestly. Right? They may take a hit this year due to the pricing of the ACA, but I think that's about it. Okay. Here, maybe I'm cheating a little bit, but honestly, founder-led, technically, he's not the CEO anymore, but he's still there. And I am inclined to give them full marks for this because the founder is well aware that he is better served, or the company is better served with him as the president of technology and not the CEO. And so if that's the case, and if you consider that the way that Mark has structured his compensation, I am very, very inclined to just give them full marks for this, despite the fact that I'm knowing Mark Bertolini is not the founder CEO of Oscar Health. Right? He basically came out of retirement to do this. I mean, he's not just in it for a quick flip. He's not just in it to make money. He's in it for the vision and mission. Are they buying back shares? I don't think that they are buying back shares. Give me a second. They have high insider ownership, I think. No, they are not buying back shares. Okay, but high insider ownership. 0.5 here. Reducing debt. Okay, they are definitely I mean, there's nothing to do here, but oops. Okay, are they reducing debt? Well, like I said, no debt to reduce over here. Exiting unprofitable segments. They don't have unprofitable segments that they're exiting. Diversifying suppliers. Are they diverse? Yeah, I mean, I guess so. You can say that, especially, moving away from the ACA, going into ICRA, increasing their market, expanding their total addressable market. Simplify operations, yes, I think with their tech platform, they're definitely simplifying operations for themselves as well as for their customers. Improve liquidity. I mean, their liquidity, they have no problem with that. No unnecessary M&A. So, I think right now, I would give them 0.5 for each. Core business can survive downturns. They don't strengthen and gain share, do they? I think this remains to be seen. After this whole debacle around the ACA, let's see what happens next year. I'll be inclined to increase this number for them if I see them continuing to maintain member growth, especially as other insurers lose members from their platform if people are unhappy with them. Then I'll be more inclined. But right now, like I said, can survive. Cash flow positive, cyclical but positive, so no problems over here. They're around they're more than 10 years, but they've survived around one bad market cycle. I don't think this, So with that brings Oscar to still a fairly high score, 29.3, still just within the high quality zone. So if you remember, high quality is around 28 to 34. And so Oscar Health scoring 29.3 is a fairly respectable score. I would think that they would do slightly worse than that. And I'm taking away points for things that, I mean, it's totally out of their control, right? This CAGR, I mean, they can't help it that they are in the healthcare industry, but it has one of the largest TAM available. They were previously only in the ACA. Now they're in the ACA plus ICRA. All right. So I think that is something that we need to take note of. And then over here, they have one dominant revenue stream, also took away half a point. But like I said, this is more of a function of the industry that they find themselves in rather than anything. Okay, so to me, I feel comfortable with that, with Oscar Health having 29.3, which is a high quality company, which is exactly where I see them at. Now, I think I remember Sergit was earlier asking about the stock-based compensation. I will really go and pull up numbers on that. Perhaps I'll cover that next week. I think what I hope to do in future, I mean, these 10 days, like I was saying earlier on when I first started, is to get me into the habit of streaming every single day and to iron out some of the technical kinks and things like that. And so with that, I hope to go live fairly frequent every week, apart from just posting a video a week. And I'll dedicate one of those streams to every fortnight to actually do a deep dive like this. So what I want to do is to, and perhaps, when I do a deeper dive into Oscar, we can take a look directly at the stock-based compensation. But if I just look at the trend of, if I just take a look at the trend of how the number of shares has increased, let me do this before we call it a night. You can see that there was a fairly, where is it? I think you can see that there was a fairly big one-time jump in terms of number of shares. Let me zoom it in for you. Okay, if you look at the number of shares here, I think there was a fairly big jump initially when they IPO'd 179, and then I think it's a bit hard to judge right now. I would say that perhaps in future you will not see as aggressive you will not see as aggressive dilution. I think that's only for a couple of years. You can see in 2023 that dropped to 4.3%. And then after that, that spiked again because some stock options were vested in 2024. And then, I think from there, you shouldn't see this number here is just an estimation. This 300 number is because I'm estimating 12%. It's just an estimation. It's not a fact. I think right now, if you look at the number itself that is on their that is reported on their 10Q, they are at around 255. So the number of shares actually fell. Right? I'm not mistaken, right? Just double confirm. Oscar Health. Pulling out Microsoft data. Yeah, so pulling out Microsoft data. Okay. So I think I was using the 10Q that wrote 2 255 million. This was 258 million using Microsoft's data. So we are more or less in the ballpark. So you can see dilution is more or less in control. Not too worried about it from here going forward. Right, so is there any questions about Oscar? I mean, we have found out, okay, at least based on this framework, it scored better than I expected. I expected it to be in the story-driven section, but it has shown itself to be a high-quality company. And personally, for me, I'm not too concerned with investing in this business. I won't make it a large part of my portfolio for the main reason that, you know, a lot of the potential pitfalls are completely out of their control. If Trump decides to not extend the subsidies, I mean, what can Oscar do about it, right? So there's nothing they can do actively to prevent some of this from happening. And so because of that, it's around 10% of my portfolio. I might be inclined to add on a pullback, especially if we get a weaker September. But apart from that, I don't really see a reason for it to be more than 10% of my portfolio. I mean, it can grow to more than 10%, but I might not be inclined to add much more than that. Let me just share the last thing with you. I know some of you were quite interested when I was sharing this yesterday. This is basically my options. This is how I basically track my options over here. Oops, sorry, that's the cash flow that I've withdrawn. Yeah, so yesterday we were looking at HIMS, right? Okay, Oscar is over here. So I didn't buy my Oscar position entirely outright. Some of it I've used options over here, and yeah, basically I sold a put that expired early in August at around $14. I realized some of it. Basically, in terms of put premiums over the month of July towards the early part of August, realized around $3,000 in terms of premiums. Oh, this is not accurate over here. Oh yeah, this is sort of accurate. Okay, I bought 4,000 shares at $15.12. And then recently I bought another 1,000 at $14.55. So you can see once you account for the premiums that I collected, adjusted cost basis of around $14.37. Yeah, with a P&L of around 16%, and that's where we stand. I haven't sold a cover call on this position because I still feel like it is in a fairly depressed territory. I'm just afraid that, you know, certain announcements will be made and then overnight it runs up to $21, $22. Now, once it gets into the $20 territory, then I'll be more inclined to sell covered calls over the position. And I wouldn't do it over the whole position. I might do it with about half. Right. So now with 5,000 shares, it'll be like 25 covered calls. I don't know. I'm inclined to increase this to perhaps maximum 6,000 shares and then sell covered calls over half that position and then use the other half to ride it out. And yeah, so that's where we stand with the position on Oscar at the moment. Yeah, I have around 5,000 shares at around $14.37. So that's where we stand. Yeah, and I did that thing again where I swiped left on my thing, but at least today it only happened once. I think yesterday it happens 4 times in the space of 10 minutes. So yeah, I think with that, wow, we have already streamed for 2 hours. With that, I will bring the night to an end. Like I said, tomorrow we're comparing Lululemon as well as ONS, followed by Affirm and Duolingo for the rest of the week. Now, this week I might not be able to do a morning stream for Grab. I'm planning to do that next week. So I will let you know the exact date, but it will be 9 a.m. Singapore time, 9 p.m. Eastern Standard. Right. So the reason for that is we want to go through Grab's earnings, perhaps take it through our framework as well. And at the same time, I want to hopefully be able to, I'm not sure, I presume I'm able to share my phone's screen on stream yet. I'm not too sure. I'll see how that works out. But I do want to just give people an insight into how the app works. We will scroll through the app, see how it works. I will be ordering breakfast on stream over there, and then yeah, you can actually see how you like the app and whether or not the investment thesis makes sense for you. Right. And so I think if you have no questions, I'm going to be calling it a night. It's already been 2 hours, and I will see you in the next one.